Welcome back. I'm Pratap here. Today is the 16th August 2024. In this video, let us evaluate the performance of high liquidity zones generated from your previous report. Yesterday, we identified 6 high liquidity zones from our yesterday's end of the day report. Out of these 6, we got a trade from INFY and we have achieved 1:5 RR during the intraday. So before we discuss all these trades and look into the analysis of the fine-tuning the zones, an announcement please. This is your first visit to our channel. Please understand we are providing complete free training on supply demand zone price action. All the training lessons are available at our NeoStock YouTube channel. So at our channel, click on this community tab, you get access to this post. This post is having a YouTube playlist link that will take you to all the training lessons. I'm clicking on the link. Now we are into the playlist supply demand zone price action course. And here so far we have 24 training lessons are available. And from these 24 lessons, we have 62 training videos are available. So you need to start your training from lesson 1.1. So for that, you need to scroll down to the bottom of the page. Here starting from lesson 1.1, all the training lessons are available in an order. So please go through all these lessons one by one and strengthen your skills related to supply demand zone price action. I have also provided the link to our Telegram channel in this YouTube video description. So from the description, from this video description, join at our Telegram channel. It will be helpful to you each time when we release a new video or any other important updates we will provide at our Telegram channel. Now let's get into analysis of the high liquidity zones we identified. So Nifty, this is a daily high liquidity zone. So yesterday we identified stocks near a high liquidity, daily high liquidity supply zone, but Nifty is also having high liquidity demand zone. So there are chances that either side we may get the trade opportunities until one of these zones are violated completely. Till then you can look for opportunities from the both sides. But anyway, today we didn't get a trade from the demand zone. So as per our software, which was near to the high liquidity supply zone, so we got a short trade today. So first let me explain how we fine-tuned the zones. Before that, the zone, we have a drop candle, 1, 2, 3 base candles, and again a drop candle. This is what our software identified. And another one is we have a rally, 2 base candles and a rally. This is the high liquidity demand zone identified by the software. So I have fine-tuned both the zones. In the 75 minutes time frame, here I identified a drop, 3 base candles and again a drop candle. With the hidden body, this is going to be a drop candle. And also one more, we have a ERC candle as a leg-in. You have 1, 2, 3, 4 base candles and again a drop candle. This is another 75 minute zone. That means we have identified 2 75 minutes zones inside daily high liquidity supply zone. And when it comes to the demand zone, here we have a drop candle, you have a base candle and again you have a rally candle. Actually this is a ERC candle, failed ERC candle. So then again, this has to be fine-tuned with 15 minutes time frame. In the 15 minutes time frame, again here we have drop candle, 2 base candles and again a drop candle. Because a long wick, we got a big zone, 15 minute zone. And follow through candles are there. So excellent zone, this is no doubt in that. But only thing is risk is high on the 15 minutes. But if you can fine tune to proper 5 minute zones, definitely you will get a good trade. That is what happened today. And when it comes to this zone, the price structure is not really good at all here. Because in a narrow range, see this is a narrow range. Look here, this is a wide range. But this is a narrow range. In this narrow range, all these are all base candles. That's why such kind of zones will be violated easily. So that's why I didn't fine tune this zone. Because there is no proper price structure here. And when it comes to the demand zone, In the 15 minutes time frame, you have a rally candle, you have two base candles, and again you have a rally candle with the pro gap. So this is the pro gap. So definitely there could be strong order flow will be there in this area before getting into this fine-tuned 5-minute zone. And again we fine-tuned these zones with the 5 minutes time frame. In the 5 minutes, here we have, see here, you have a ERC candle. This ERC candle, drop candle, is a failed ERC candle, can be considered as a drop candle because we have to look into the dynamic view. At some point of time, prices came up and then came down. Because finally the prices came down, that means prices are dropping. So we can consider this as a drop candle. So it's a failed ERC candle. Failed ERC candle can be used as a leg in. Failed ERC candle also can use as a leg out only in some special scenarios. You are not aware of those concepts. We will discuss them at some point of time in the future lessons. But time being, that is not really not to be considered at this stage. Some of your experience should grow. Your dynamic way of looking into the zones, that kind of skill has to be built. Once your experience grows, you will get such kind of understanding. But time being, this is no issues with this because this is a leg-in candle. And here you have a base, excuse me, and then you have a drop candle, follow through candle. This is the way. But what I did, I have fine-tuned up to this zone. I have fine-tuned till this area because exactly this is in line with this 15-minute zone. The 15 minutes proximal, and of course 75 minutes proximal is also near to this. So that prices will enter into this 15-minute zone. At the time we will take the trade. Exactly we fine-tune. Why I did like this? Because the risk is very high. That is one reason. Second reason, this entire zone moved out of the entire high liquidity zone. That's why at some point of time you need to adjust the price to one of the fine-tuned zones. Still you can take an entry at this daily proximal line. That possibility here also you can take. But risk management is more important. Still you can consider type 3 proximal entry. Type 3 also you get the entry. Type 3 also. But if I have a fear that sometimes we may miss the trade. But today prices enter into this type 3 proximal level, but that is a different story. But many times there are higher chances type 3 will be. So that's why it's a trade-off. What is the trade-off? Exactly at the 15 minutes proximal, an entry till that I adjusted, so that risk will be within our limit. What about the reward? Reward will be 15 minutes supply zone, but here we have a problem today. Okay, meanwhile here demand zone is also fine-tuned. We have a drop, 2 base candles and a rally with pro gap. Even till type 3 proximal, see the high of this candle, that is exactly at the type 3 proximal. It reached. But anyway, we did a risk management up to 15 minutes by fine tuning. Then where is your target? Your target will be rally 1, 2, 3, 4, 5. This is a leg candle, medium size, but still okay, we can keep sometimes. That way you can draw the zone, but the problem is there is a pro gap is there. Many times I told you when there is a pro gap, many times prices won't reach your target. Then in that case, how to handle? Previously, you may see some videos I explained in important videos and analysis. Earlier I explained, whenever there is a pro gap, just before a little above pro gap, exactly at pro gap you can keep, but many times just before there are a lot of order flow at the starting of the pro gap. So before reaching pro gap, a little before, prices again will go up. That possibility is also there. See, today that is what happened. Prices came. So this is the pro gap area. Let me draw a horizontal line. Sorry. See, prices just before reaching pro-gap, again they moved up. Such kind of risk is there. That's why I told you, maybe exactly at the pro-gap starting or little above, you can keep your target. That way you can exit. That is one solution. And another solution is RR. Maybe you can achieve 1:5 RR, or you can achieve 1:3, whatever you are expecting the profit. That way you manage. See, here I just adjusted up to 1:5 RR. Today it reached up to 1:2. So whoever is looking for 1:5 RR, your profit, you would have got the profit. Some people go for 1:3 RR, still you will get. Some people will go for 1:4 RR, still they would have got the profit. But profit margin will reduce if your RR is going down. But anyway, it has given a good RR, 1:5 RR from here to here. So what is it? I have drawn this. After that, I just moved like, see, this is what I did. I just dragged down until it receives 1:5 RR. That is the way I adjusted. And wherever 1:5 RR is there, exactly there I stopped. Here. See, we got 1:5 RR. Today achieved. Prices reached up to this 1:5 RR. This is the entry. Where is the entry? Exactly at 15 minutes. Because we adjusted our entry to 15 minutes proximal. Why we did like that? Because 5 minutes entry is moved out of the high liquidity zone. So that is the reason why we adjusted till the 15 minute zone. And we have kept some stop buffer also there earlier above. And with this stop buffer, we adjusted the 1:5 RR. And today, INFY reached the prices up to this 1:5 RR. Just little below, but that is okay, maybe 15 minutes. That means today's low of this candle, today's low, some, I think some 30 paisa or 40 paisa above itself, we would have exited. Because our RR is 1:5 RR near to that. See, after that, how sharply the prices moved. The reason is because of the pro-gap area. Many people do this kind of, because they use their profit booking at this level. When more and more people are exiting at the 1:5 RR level, some obviously buying pressure it will get, and then it will be started moving up. So that's why whenever there is a pro-gap, carefully you should take the decision. So how much profit? After that, this zone is violated. And even the fine-tuned 75-minute zone is also violated. One more 75-minute zone is there, but we didn't fine-tune because this zone also will be violated. Maybe tomorrow, this zone also will be violated. After that, the whole zone might be high liquidity, supply zone might be violated. This is the only one area order flow is there that has given for us 1:5 RR it has given from the fine-tuned 5-minute zone. We are able to achieve because we adjusted our entry till 15 minutes proximal line. That's why we achieved 1:5 RR. If you would have taken 5 minutes proximal line, probably you would not have got the RR today. That's why all these techniques are very, very important. They are very important. Fine-tuning the zone is important, that you land in your lesson 16. At the same time, fine-tuning the risk management is also important. See how I did the entry level, I adjusted. First I did entry level. After that I looked for the RR before the pro-gap. That's why adjusting the entry is an important skill you have to build. Of course, if you don't adjust your entry properly, sometimes you will be missing the trades. You won't get the loss, but you will be missing an opportunity sometimes. Missing the good opportunity is also, it's not good, right? You have a good opportunity, you missed it. So that's not a good, maybe you are not getting loss by missing the entry, but missing the opportunity is always not a right choice. So that's why proper way of fine tuning the risk is very important. So your risk should not go up, at the same time your entry also should not. Because I have the belief price definitely reach a 15 minute zone. That's why the 5 minutes entry I adjusted with 15 minutes proximal. See how nicely it worked out today. After that 1:5 RR profit also we got. So how much profit Nifty has given? Nifty has given 5,220 rupees profit, which is a 4% ROI based on one future margin cost. Okay, it is 2% less than our average intraday ROI. That is okay. Because sometimes some trades we get less than our intraday ROI, sometimes we get even more. See here we got 11.8%, 6.8, 8.5. Finally all these averages you will be getting 6%. So this is one successful trade. And the next SBILIFE is also very interesting, but it's not an easy analysis. To be frank, even I also not able to do that analysis, whatever I am going to explain. I am explaining post-mortem after the trade happened. When I analyzed why such kind of price action happened, when I did that analysis, then I come to know the reason. Otherwise, it would have been a very good trade, SBILIFE. But finding such kind of trade is not easy. I told you, even I missed it in my analysis part. I have to accept that. But it's a learning. So that's why everybody, please focus. It's a learning for you. I learned means that is also going to be a learning for you. So this is a 75 minutes high liquidity zone. Stocks near demand zone. Yesterday we got, but this is also having a high liquidity supply zone also. SBILIFE is having both high liquidity demand zone and high liquidity supply zone on a 75 minutes time frame. So here we have a rally, 2 base candles and a rally. And again here you have a drop, 3 base candles and again a drop. This is the 75 minutes supply zone. Drop base drop, here rally base rally. And both these 75 minutes zone fine tuned with 15 minutes time frame. In the 15 minutes time frame, in the demand zone, I have identified only one zone, a valid zone. This is the one. We have a drop, 2 base candles and a rally candle, ERC candle, rally candle. This is when it comes to the demand zone. And when it comes to the supply zone, in the recent price action, we have a rally, 1, 2, 3, 4 base candles and again a drop candle. And again you have a drop candle, base candle, again a drop candle. So we have identified 2 zones. Rally based drop and drop based drop. These are the 15 minute zones. And when it comes to the 5 minutes time frame, in the demand zone, where is the demand zone? Okay. Here we have a drop base rally is there. Drop base rally, prices moved up, again came down, picked up the orders and again moved up. Started moving. So that's why this is not a valid zone. You may say here we have a rally, base rally is also there. This also we can, but somehow I am not convinced with rally based rally. The reason is it picked up the orders from this zone and moved up. So that's why giving priority to this zone, drop base rally. But this is a tested, already tested, and also prices went more deep. See, a leg out is created means there could be a strong order flow in this zone, but already went deep inside. That's why I have some doubts about this zone, whether to accept the second trade or not. Even at type 3 proximal level also it covered already, it occupied. So that's why I'm not really happy with this. But what happened here is, if you look into this zone, It is having again a drop, base, rally and follow through candle. Of course, I agree, this is not a great leg out, but next follow through candle is very strong. So that is the reason why I consider this, because sometimes we can compromise and draw the zones. If there are proper reasons, those zones work very well. Why I am focusing on this is, you may say this is already tested. See here, prices came down, it picked up the orders multiple times and again moved up. Why I am interested on this zone is, see the price action in the following candles. See again. Once again from this zone it picked up and moved up. Once again from this zone it picked up, moved up. And recently also again it picked up the zones and moved up. Again came very close with some entry buffer, you would have got the trade. And again moved up. And today it is violated. Okay, forget about today's. The reason why I have drawn this zone is, this is a high liquidity zone. This is the point you have to observe. This is a drop base rally and follow through candles is a high liquidity zone. It is supported multiple tests, several times, maybe 5 or 6 times. This zone was tested until today. Maybe today it is violated, because we know any high liquidity zone has to be violated on some time. It is having an expiry time. Always I tell this point. Every high liquidity zone might be having some expiry time, but we never know when is going to be the expiry. Until it is violated, you can try. That is up to you. This point also I always say. Whether you take, some people what they say 4 or 5 times, if the zone is tested, they don't take trades. It's up to you. It's all depending on your risk management. And it's all depending on your acceptance. So that is the reason why high liquidity zone. So it is purely up to you guys. Up to the individuals. What I mean to say, it is up to the individuals whether to accept trades or not. Previously, whoever continuously accepted, they would have got several profits. Maybe today, whoever took a trade, maybe they would have, their stop loss would have been hit. See the blue color line what I have drawn? This is with stop buffer. This is going to be the stop loss, the blue color line. Okay, moreover, this is an aggressive trade. Why it is an aggressive? There is no fine-tuned zone. Because there is no fine-tuned zone, it is an aggressive trade. An aggressive trade, several times the zone is tested. Many people definitely may reject this zone. Some people who wants to try one more attempt, they will take a trade. It's purely up to you. But whether you take the trade or not, that is not the question today. There is some interesting learning is here. Even I missed in my analysis, I have to accept. Why I missed? Because generally we don't do such kind of in-depth analysis in every trade. Because once in a while we see such kind of trades. What is that we missed? A bear trap. Generally we look for high liquidity. Bear traps or bull traps below or above the high liquidity zones. But many times, because we are using high liquidity strategy for daily or 75 minutes time frame, we look for bear traps or daily, or we look for bear or bull traps from daily zones or 75 minute zones. What kind of zones? High liquidity zones. We already discussed about bull or bear traps in lesson 21. I explained in one of the videos, because we have several videos in lesson 21. In one of the videos, I explained bull trap and bear trap clearly. And mostly we look for this bull or bear traps in daily and 75 minutes high liquidity zones, because a lot of order flow is there. Institutions cleverly they keep the traps. It doesn't mean institutions does not keep traps inside the in below or above 5 minutes high liquidity demand or supply zones. They will also keep, rarely they keep. If you are having a 5 minutes high liquidity zone and which is working like anything, like giving you several successful trades, sometimes institutions may choose such kind of lower time frame high liquidity zones. 5 minutes is a lower time frame high liquidity zone. But further there is one more lower time frame is there, that is a 1 minute time frame. For below 5 minutes we have 1 minute time frame is there. Of course some people also use 3 minutes also, but the right choice for 5 minutes is 1 minute. So there are higher chances institutions may keep 1 minute zone as a trap for 5 minutes high liquidity zone. Are they going to do every time? No, rarely they may do. When people are showing more interest to a particular area where the price action is again and again and again and again supporting, probably they may select such kind of zones. Maybe this could be one reason why they selected this 5 minutes high liquidity zone. If you look into this 5 minutes high liquidity zone, see here several times it is tested. Already earlier it is tested here. See here prices moved up, came down, picked up the orders, and again came up, once again second time it picked up the orders here. And again here third time it picked up the orders here. Came here and moved up. And again fourth time again it picked up the orders. And again fifth time it picked up the orders from here. And the sixth time very close to the zone. Seventh time today it's violated. But what institutions has done? They have done a great analysis here, because they know how to trap us. Because this area prices are keeping again and again, it will attract even conventional technical analysts also. Those who does not use demand and supply zones, but they will be using support and resistance. They draw a horizontal line from where again and again prices are taking the support. Exactly in this zone area they draw the horizontal line. And they will also, conventional technical analysis, they will also draw a rectangle box here. They won't follow supply demand zone principles. They randomly select some range from where prices are moving up and down. A small range they select, that way they consider that. This is an extension to the normal support and resistance concept. These are the different. So definitely all the traders will be attracted to this concept. Conventional technical analysts, what they do, they keep their orders here and their stop loss is hit today. Prices came below and immediately because stop loss hit, they go for short orders. That means bears. Now below there is a 1 minute demand zone, there all the bears are captured. That means whatever they are going for short, institutions will be buying those shorts. That means institutions go for long trades. All the technical analyst people, they keep on going for short trades because their stop loss is hit. They need to exit from the trade. They need to exit from their long trade. So they go for a short trade. Shorts means bears. Now institutions are buying. They are going for long trades. That means they are bulls. So bulls are capturing the bears. That's why, because to capture the bears, institutions set the trap. We call it as a bear trap. That is what I clearly explained in lesson 21. Look into the 1 minute zone. How nicely they kept just below the 5 minutes high liquidity zone. See here, we have a rally, base, rally, nice follow through candles. It has a very good move in the 1 minute time frame. After that prices came down, and from this 1 minute area, see here, it picked up. See the rejection. That itself is indicating there is a strong order flow in this area. That's why institutions, and below this zone itself, it was, see the rejections. And after that prices further moved up after some time. So that's why institutions selected this area and kept a lot of long orders here to capture all the shorts below this zone. See how nicely 1 minute bear trap captured all these stop out trades today. That means a lot of liquidity is generated in the form of shorts because of stop out. See, after adding the stop buffer, the blue color line is the, this blue color line is the stop buffer. Definitely below the blue color, even many people would have exited. Some people don't use these blue color, the stop buffers, they would have exited here. Below the 5 minutes high liquidity zone, they would have exited. Those who added stop buffers also exited below the blue color. Institutions captured all these orders. They captured all these orders from this zone. They might have, from this zone means above, within the zone and a little above, they would have kept a lot of long orders. Whenever they are selling, they keep on going for longs. They keep on buying. Institutions keep on buying. All stop out trades, institutions keep on buying till below this blue color line. Everything they captured. And after that, see the move. It's a very big move. From here to here, the 15 minutes supply zone. There is a 15-minute supply zone here. Have a rally-based drop. And this is holding the prices. And today also, they pushed the market till this area. You know, it would have, if anybody would have identified this zone, I know it is not easy. Even I didn't go to this much depth in my analysis. I identified this 5 minutes high liquidity zone, that's it, I'll just left it. It is violated, I know that the zone is 5 minutes, lifetime is over. It is expired, no more it is a valid high liquidity zone. Once the price came just below the distal line, okay, I thought this lifetime is over. But actually prices should further go down. That didn't happen because below we have a fine-tuned zone, but even though it is a tested one, it has to be violated. But prices went a little below the stop buffer and then started moving. Then immediately I realized institutions nicely trapped everybody. The moment it started moving, immediately I realized there is a bear trap below the 5 minute zone at 1 minute level. And then I went and saw, I have seen that excellent 1 minute zone. If I would have done before the market starts, then my analysis would have been a great analysis. But that didn't happen because I didn't go that much depth. The reason why generally I don't go is these 5 minute zones, high liquidity zones are inside daily or 75 minutes high liquidity zones. So that is the reason why I don't give that much importance to the bull or bear traps below inside the high liquidity daily 75 minutes. Because we can't do that much analysis every time. Because many times below these 5 minute high liquidity zones, the bull or bear traps will be violated easily. This 1 minute zone will be violated, prices will go down further. Many times. Once in a while, institutions take such kind of steps. There are higher chances why they have selected is because it might have attracted so many traders. See here, multiple times it is a testing and not allowing us to go beyond this particular 1 minute zone. Beyond this 5 minutes high liquidity zone. It's not letting the prices go down below the 5 minutes. That's why it would have attracted so many long traders. That means so many bulls. All the bulls are captured by the institutions today. How they captured? Because bulls will become bears the moment the stop loss is hit. All the bulls who took the long orders will go for short trades once the stop loss is hit. That's why bulls are turned out into bears to exit from this because their stop loss is hit. Now these bears, that means once on a time, sometime before they were bulls, took long trades, and because their long trades are their stop loss is hit, now to exit from the long trades they have to go for short trades. Whenever they are going for the short, in institutions simply capturing that shorts by going for a long. According to the institutions, we are all going for shorts because our stop loss hit. That means we are all bears. Because all the bears are trapped. So that's why this is called as a bear trap. This 1 minute zone is called as a bear trap. Because that zone is trapped all the short trades. Maybe this explanation is useful for those who didn't complete lesson 21 and still listening this video. Still those who completed lesson 21 bull bear trap, still it is going to be a revision for you. That's why I'm spending some extra time to explain this concept. Because this is the right example. Now you understand this concept much better way now. Because you are seeing the live example today. And after that, this bear, this bear trap, that is 1 minute bear trap, this demand zone has given 11,300 rupees, which is 11% ROI as per one futures margin cost. The cost is also very less today. It is only 1,20,000 rupees, the one futures margin cost. Around 1,20,000 around. So it's gave very good profit. But anyway, according to our analysis, this is the fine-tuned zone. This is a drop, base, rally, and the fine-tuned 5-minute zone. Which is already tested. That's why we didn't plan any trade in this particular SBILIFE. But only high liquidity traders looking for aggressive trades, those they might have been stopped out today. The aggressive traders, the 5 minutes high liquidity zone, whoever is considering today's trade, probably their trade would have been stopped out today. And rest everything is your learning point of view. How institutions are trapping us. Because this is the important point you have to learn. Because sometimes we will be trapped. Sometimes we get loss. We have to accept the reason why we are getting the loss on that day. Today, this 1 minute zone did the entire magic and gave very good profit to the institutions today. So institutions captured our money today. That is what you have to understand. Okay. Except this, we didn't get any other trades today. But how I fine-tuned the remaining zones, let me explain. First one, next one is ABAT. This is a daily high liquidity demand zone. So we have a drop candle, we have 1, 2, 3, 4 base candles and a rally candle. This is what our software identified. So in this identified a 75-minute zone. We have a rally, base, rally. Rally, base, rally. This is in the recent price action. This is a new 75-minute zone. And at the time of zone creation, we have another 75-minute zone. Drop, 2 base candles and rally. Again, I fine-tuned these zones with 15 minutes time frame. And the 75-minute zone is again having a rally, 1, 2, 3 base candles and again a rally candle. Rally, base, rally. This is a 15-minute zone. But have you noticed inside 15-minute zone, I didn't fine-tune 5 minutes. That means 5-minute structure is not good. But anyway, we will look into that in the 5 minutes. But we have one more 75-minute zone in the recent price action. So here you have a rally, 1, 2, 3 base candles and a rally. Have you noticed this entire 75-minute zone, fine-tuned 75-minute zone recently created? Before the creation, there is a 15-minute zone was created, a rally, 3 base candles and a rally. And from this zone, it picked up the orders and a new 75-minute zone is created. That means the new 75-minute zone is created by picking the orders from this 15-minute zone. You know the strategy. The lower time frame zone as an horizon to the higher time frame zone. Lesson 22 or lesson 23. In one of these lessons I explained. A new strategy I developed in the recent period. Many times this kind of strategy has given successful trades. Of course, this is all again, this zone is also having a fine-tuned 5-minute zone. So actually the orders are picked up from this fine-tuned 5-minute zone inside the 15-minute zone. Of course, everything 75 minutes, daily 75 minutes, 15 minutes and 5 minutes, they are all overlapped. They are all fine-tuned, but they are overlapped at the distal line of the 75-minute zone. That's why it is having an importance. Sometimes the 75-minute zone will be violated. Still, it gives good trades below because we have a fine-tuned, the origin is available. The origin from where it picked up the orders. That origin is having the strong order flow. But unfortunately, today we didn't get the trade. Prices didn't get into this area. Sorry, 5 minutes I didn't show you. I am changing the time frame to 5 minutes. So here you see, you have a rally, 2 base candles, a rally with hidden body and pro gap. Of course, now there is no more pro gap because it already picked up the orders from here at the time of this 75-minute zone creation. So this was one trade we planned, but the prices didn't get into this area today. So we didn't get a trade. But why we didn't fine tune the another 15 minutes zone? This is what you should understand. The reason is all these so many base candles 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, all in a narrow range, and within the small range so much of candles. Generally many times what happens, such kind of see, at least there is up and down movement is there, that's good. There is no up and down movement. All candles are just within the same. So that's why this price action is not good. That's why price structures are very, very important. Always I used to say price structures, understanding the price structures. And below also there is one more rally, base rally is there. See here. That's why I know that this zone will be violated easily. There is not much importance is there to talk about this particular zone. Okay, this is about India. And today prices did not get into the fine-tuned area. Look into today's candle. Today's candle, it went into this zone but not into the fine-tuned area. It touched the 75-minute zone but not the fine-tuned area. Next one is RBL Bank. This is also on daily time frame. This is also a daily high liquidity demand zone. When this zone was created, 11th July 2023. Sorry, 12th July 2023 is the leg-in, after that base and rally. Then when I looked into the, actually 15 minutes, 5 minutes I didn't fine tune, until 15 minutes I fine tuned because 5 minutes data is not available. Because only 1 year data is only available for what to say, in trading view. For me only 1 year data access is there. That's why I didn't fine tune to 5 minutes. But still I will tell you how I did the fine tuning on 75-minute zone, because there are multiple 75-minute zones are here. Sorry, multiple 15 minutes are there. 75 is only one. You have a drop, 2 base candles and rally. So excellent one. So within that again 15 minutes time frame. And 2 15-minute zones are identified here. This is the one, we have a drop, 3 base candles and a rally with a hidden body. So you got a very good excellent. After that again prices came, slightly picked up the orders from this 15 minutes area. Again a leg candle is created, and then again a base, and again a rally, rally, base, rally. So another 15-minute zone. This cannot be considered as a base candle. This is a medium size leg candle. So rally candle, again rally candle, again rally candle. So that's it. I can't fine tune these zones, so can't plan any trades. But anybody is having any access in the other platforms you are using, maybe you could have fine tuned to the 5 minutes time frame. But anyway, today prices didn't get into this area, so that means there is no question of getting a trade. But the only thing is how we fine tune. That is what the learning people experience. INFY already we discussed, we got a trade, and Bandhan Bank. This is also a daily high liquidity zone. Daily or 75? Let me check. Bandhan Bank, I think 75 minutes zone, not daily. Okay, this is a 75 minute zone. We have a rally, base rally. Today we didn't get a trade. See, prices didn't enter into this area today. But how we fine tune? Because sometime prices may get into this area. See, yesterday or day before yesterday's video, I explained LTF, L&T Finance. LTF means not lower time frame. Please remember. It is a L&T Finance stock. Stock code is LTF. So in that LTF stock, 2 months back we fine tuned, and 2 days back we got the trade. So that's why understanding how we are fine tuning the zones is important. So this 75 minute zone again fine tuned with 15 minutes time frame. See, here we have a ERC candle as a leg-in, you have a base, you have a rally and follow through candles from here. So we have a 15 minute zone. That 15 minutes again fine tuned with 5 minutes time frame. How we fine tune? Let me explain. See, here a drop candle, ERC candle, you can use as a leg-in, and then 3 base candles and a rally candle. And thereafter a very big move towards up. So this is the area you can plan in this fine tuned area. But anyway, today prices did not enter into this area. We didn't get a trade. And the last stock is SAIL. SAIL is also a 75 minutes high liquidity zone, high liquidity demand zone. We have a rally. We have 3 base candles and a rally candle with pro gap. But within the 5 minute, within the zone, there is no proper structure, but the new concept you land, lower time frame horizon for creation of the higher time frame zone. That is what happened here at the digital line of this 75 minute zone. So go to the 15 minutes time frame. Now we will understand that concept. See, this is the 75 minute zone. The low of the 75 minutes candle picked up the orders from this zone. Rally, 2 base candles and a rally. And this 15 again having a proper fine tuned 5 minute zone, exactly from there it picked up the order. Just touched the digital line of this 5 minutes and see the move. So that means this entire zone picked up the orders and then started moving up. That means there is a strong order flow in this fine tuned 5 minute zone. That fine tuned 5 minute zone is the horizon for the creation of entire 75 minute zone. That way we can understand at least. See here. You can use, actually this is a compromised. Sometimes, I previously also explained. Sometimes we can compromise and draw the leg-in candle. This is not actually a leg candle, this is a base candle. But why I compromise and draw? There should be proper reason. Without the reason you cannot do. See, prices were moving up from here. After that there is a narrow range. I am considering this narrow range as a base. Because you already land. Prices will be moving in a narrow range. That should be used as our base. Mostly there a strong order flow will be there. So that's why I ignored this candle. Because I ignored, okay, I am considering this as a leg candle. Many people, I am sure, you don't accept this is a leg candle. You do a lot of arguments because its body is less than 50%. Yes, that's true. Here experience comes. Why I have drawn in this is the area prices moved narrowly. And from this candle, prices moved up. That's why I am just ignoring the principles, simply considering it as a leg candle. That's it. I mean, not leg candle, legging. I am considering this base candle as a legging. That's it. But here importance is on this area. All these points you will understand once your experience grows. Where to compromise and draw, where you should not compromise and draw, all these things you will understand over a period of time. But don't expect this kind of knowledge or experience during your initial stage. You need to observe so many charts, you need to analyze so many charts, then you will be in a position. Here prices are settled and moved in a narrow range. That's why I just consider only this area as my base. And below the base, whatever the candle, that is a legging. That way I assumed. Because here my importance is on the base and legging. Some people say, if legging is not good, the zone won't work properly. They are all bullshit discussions. It's not about the legging, it is about the base, how strong the institutional order flow. Because of this order flow only, the imbalance took place. See, imbalance happened here. Earlier prices moved in a balanced way. This is what I explained in lesson 2. Always I say lesson 2 is my favorite lesson. If you properly understand the essence I explained in lesson 2, then you will never make mistakes. Because there I clearly explained how institutional price movement takes place. That is what I explained in lesson 2. That's why each and every word in lesson 2 you should carefully listen. Earlier prices moving in a balanced way. All of a sudden the balance is changed to imbalance. Imbalance means out of the balance. Instead of moving narrow range, prices started moving up. Why it happened? Because institutions participated here. They added lot of order flow. That's why in this area, in this narrow area, you can find institutional strong order flow. That's why see the rejections. How it moved up. Again rejection, how it moved up. That means it picked up the orders. This entire 75 minutes high liquidity zone is created. How created? By picking the orders from this area. That's why critical order flow will be there. That is what you learn in lesson 22. If I am wrong, it could be lesson 23. Lesson 22 or lesson 23. Please correct me. One of the lessons I explained lower time frame zone as an horizon to the higher time frame zone. So that's why here we have the real trades will be available. So I don't want to miss this zone next time when prices enter. Of course, these zones will violate, but they have good success rate. At least one more trade, a very good trade we get from this zone. Maybe two more trades also you may get. Because sometimes they will also work like a high liquidity zone. Such kind of zones. First of all, what is high liquidity zone? Strong institutional order will be there. And institutions again and again in the same area they add new orders. That's why again and again that area will be giving us the trades, multiple trades. That is what we have seen SBILIFE. How many trades it has given? Nearly 5 trades or 6 trades it has given. And today only that zone was violated, the 5-minute zone. Exactly the same way we know that this area lot of liquidity is there. How do we know lot of liquidity? Because small zone, small time frame, 5-minute zone was responsible for the creation of higher time frame zone. All these points are revision to the points you learned in lesson 22. If I am wrong, it could be lesson 23. Any one of those lessons. Okay, anyway, today we didn't get prices didn't enter into this area, we didn't get the trade. So this is about the analysis of high liquidity zones identified in our previous report, and also hope you have a lot of learning in this video. Let's all meet again in our next video. Thank you.